when bad economic news became good news for stocks. For most of history, weak economic news was bad news for markets. A slowing economy meant weaker profits, fewer jobs, and greater risk. But during the age of easy money, that relationship began to reverse. A disappointing employment report could send stocks higher. A weak manufacturing survey could spark a rally. Investors were no longer reacting only to the economy. They were trying to predict the Federal Reserve. The logic was simple. If growth weakened, the central bank might cut interest rates, delay an increase, or buy more bonds. Lower rates reduced the return on cash and government debt. They also increased the present value of future corporate earnings. The worse the news looked, the more support markets expected. This expectation became known as the Fed put. A put option protects an investor when prices fall. The Federal Reserve never promised to rescue stockholders, but decades of intervention taught traders that severe market stress would often bring easier policy. The pattern had roots before 2008. After the 1987 stock market crash, the Fed supplied liquidity. It eased during later crises, including the collapse of long-term capital management and the bursting of the technology bubble. Each response had legitimate economic reasons. Together, they created a powerful market memory. Then came the global financial crisis. The Fed cut its policy rate to nearly zero and launched quantitative easing. By buying Treasury and mortgage securities, it pushed longer-term yields lower and supplied reserves to the financial system. The objective was to stabilize credit and support employment. But the policy also transformed the way assets were priced. When the safest bonds yielded almost nothing, investors searched for alternatives. Money moved into corporate debt, real estate, growth stocks, private equity, venture capital, and speculative assets. Rising prices improved confidence and made borrowing easier. Financial conditions became a major channel through which monetary policy affected the economy. This created a feedback loop. Weak data increased expectations of Fed support. Expected support lifted asset prices. Higher prices loosened financial conditions and softened the economic damage. The market began to behave like an informal part of the policy mechanism. But the relationship was never guaranteed. In 2013, Fed Chair Ben Bernanke suggested that the pace of bond purchases could eventually slow. Treasury yields jumped and emerging markets sold off in what became known as the taper tantrum. The lesson was unmistakable. Markets had become highly sensitive not just to policy decisions, but to a few words about future policy. By 2018, the Fed was raising rates and shrinking its balance sheet. Stocks fell sharply late in the year as investors feared that policy was becoming too tight. In early 2019, Jerome Powell signaled patience and flexibility. Markets rebounded. Traders called it the Powell pivot. The episode reinforced the belief that falling markets could change the central bank's course. Investors watched speeches, press conferences, and every line of official statements. Economic reports became inputs into a second calculation. What will this make the Fed do? The pandemic pushed this system to its limit. In March 2020, markets froze and the economy stopped with extraordinary speed. The Fed cut rates to zero, launched large-scale asset purchases, and introduced emergency lending facilities. Congress approved enormous fiscal support. The intervention prevented a financial collapse, but it also helped produce one of the fastest market recoveries in history. Stocks began rising months before employment and output fully recovered. Technology shares, cryptocurrencies, housing, and speculative companies surged. Bad news about the present mattered less than confidence in policy support and future reopening. The phrase, "bad news is good news," captured this strange world. Yet it was only true under certain conditions. Weakness was positive when it reduced interest rate expectations without destroying corporate earnings. If the economy weakened too much, recession fears overwhelmed hopes for easier policy. If inflation stayed high, the Fed could not rescue markets so easily. That limit became clear after 2021. Inflation accelerated far above the Federal Reserve's target. Suddenly, strong economic news could be bad for stocks because it implied that rates would stay high. Weak news sometimes helped, but only if inflation was also cooling. Markets were still trading the Fed. The direction of the trade had changed. The easy money era left three lasting effects. First, interest rate expectations now influence nearly every major asset. Second, central bank communication can move trillions of dollars before a policy decision occurs. Third, investors have learned to treat financial stress as a forecast of government action. This does not mean the Fed controls the stock market. Its legal goals concern employment and stable prices, not a particular index level. But asset prices affect borrowing, spending, confidence, and financial stability. That makes markets impossible for policymakers to ignore. The deepest change was psychological. Investors stopped asking only whether a company, sector, or economy was strong. They also asked whether weakness would summon cheaper money. For more than a decade, that question shaped every rally and every sell-off. Then inflation arrived and forced a harsher question. What happens when the central bank can no longer save markets without making the larger problem worse? In the final episode, the inflation shock that ended easy money and the financial wreckage left behind when rates rose at the fastest pace in a generation.